FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's a 128.20. Well, just when you think the bull market is going to go to the sky, the tree is going to grow to the sky, it's going to go to the moon, well, then we get the coronavirus. Does that mean the end for the U.S. and global bull market in stocks? That's the question. What's your opinion? We'd like to know. Email us, kl@kerrylutz.com. By the way, if you've been on the website, we're doing some work on it. I told you one of our goals for the year was to upgrade the site, make it more mobile friendly and more just responsive, more modern look, and still bring you all that great information along with all the podcasts that we do and others that we find significant. So bear with us. We'll be done with it shortly. And email us, kl@kerrylutz.com, with your comments and opinions on the market. Well, someone who always has an opinion on the market, Crista Huff. Crista, you were last with us, and you basically were extremely bullish about the market, unabashedly, I might add. And you were correct up until this nasty virus reared its ugly head in China, causing mass panic. Now there's somewhere, I don't know how many, 20 to 50 million people quarantined. You watch the videos. I knew that Chinese people cursed a lot, but when they're seeing all these health people come in their hazmat suits, they're a bit freaked out and they're like really angry. The inability of the Chinese government to adequately handle this, and I don't know that any government could, totalitarian or otherwise, these things kind of run their course, is yet another dent in the prestige of President Xi, and could have widespread ramifications for the international global financial system, couldn't it?
Yeah, and it's definitely going to have widespread implications for travel, and whether it's leisure travel, cruise ships, airplane travel, anything where people gather in large numbers in close spaces. So I'm expecting travel stocks to fall quite a bit, and I will be bargain hunting among those when the whole panic is over.
Yeah. So what stocks get hit the worst? Because it also is that's going to inhibit or hinder trade by ship, trade by airplanes. A huge amount of our trade with China, especially in technological goods, comes in on aircraft. So, and what about the guys flying over there who work for the airlines? All of these things, they're unanswered questions, and that uncertainty is what leads to issues with the stock market, isn't it?
Yeah, the stock market hates uncertainty and surprises. So just backing up a tiny bit, I will point out that the S&P 500 stock market index rose about 10% from when it broke out of a trading range in late November, and then it rose through mid-late January, about 10%. Now, 10% is not necessarily a huge move on an individual stock, but it's a big move on an index. And so in recent weeks, I've been writing to my subscribers telling them, look, we're due for a correction. Anything can trigger it. It could fall based on politics like impeachment. It could fall based on economic news. It could fall for literally any reason at all. And then all of a sudden the coronavirus came along, and this seems to be the thing that's triggering a short-term stock market correction. And I just, want to remind people that corrections are perfectly normal. They happen just about every single year, if not several times a year. And yet over the long term, the stock market advances. So I'm not saying that anybody who owns stocks should be panicked. I'm just saying maybe be prepared to buy low in a couple of weeks.
Yeah. And that, that's a very sensible way of looking at things. But people often, when they get scared, when there's fear, blood in the air, whatever, they don't look at things sensibly, right?
Right. I'll tell you that I normally get maybe just one email a day from subscribers, and I've got over 1,000 subscribers. And last week it was up to 5 to 10 emails a day, and almost every single one was asking about stop loss orders on their particular stocks. Mostly because I'd written about stop loss orders, but it's not unusual for me to write about things and get no reaction at all. But when I wrote about stop loss orders, everybody wanted to do it. And so I had to really go into detail and explain how and why and whether, how to identify a stop price and what to do next. Because I know from experience, I was a retail broker at Morgan Stanley for, at least a dozen years. And I know that a lot of folks don't handle stop loss orders very well. And after the stock sells, they sit at their computer staring at the former price of the stock rather than moving on because they don't have a game plan. You need to know in advance what you're going to do with the money if the stock sells.
Yeah. So what do individuals most handle incorrectly when they are implementing stop loss orders?
One thing that I think that they do wrong is they use a percentage instead of a specific dollar amount. So if the stock was at $100, they put in an arbitrary 5% stop loss or a 10% stop loss. But as a person who follows price charts, that's technical analysis, stocks have trading ranges. And it's not that hard, even I think, for, a somewhat of a novice to look at a price chart and figure out what is the recent trading range. Let's put the stop loss order below the recent trading range so that it can continue to do its normal bouncing around, but it would only sell if it falls further than what has recently been normal. Now, to me, that's very logical, but I guess because a lot of people don't read price charts, they just try to go with like a straight 5% or 10%. Well, lots of stocks can fall 10% within their normal trading and bounce right back up. Tesla would be a good example. And so they watch it bounce right back up and they're like, oh, I hate stop orders. This doesn't work. Well, it didn't work because they hadn't put quite enough thought into it yet. I mean, investing in stocks is complicated. There are so many moving parts, so many concepts, so many influences to individual stocks and industries and countries and economics. So you can't expect to be an expert at it right out of the gate. But that's why people send me questions and they're like, okay, how can I do this better this time? And so I start by talking to them about trading ranges. And then I emphasize, look, you need to know in advance what you're going to do with that capital if it sells, because during the stock market correction, your stop order will get triggered. Your stock will sell. You're going to have a bunch of capital sitting in the money market fund. You either need to know in advance that you want to buy low during the stock market correction, in which case you can relax that you have that capital, or you want to have a list of stocks lined up that you would love to buy at certain prices. And so if your Apple sells, for example, you're going to look at your list and you're going to be like, oh, I love JetBlue and I love Netflix and I love this other one. Let's buy Netflix today. So you have to make a constructive, forward-looking move so that you're not sitting there at your computer looking backwards at the stock that you just sold.
Yeah, and then what you said is so true. Having this strategy in place really is what it's about. Because like you said, all right, I'm out of these stocks. Now what do I do? And if you have that follow-up list of stocks that you're going to go into, but you raise a really good point, and not just for pullbacks, but the benefits of stop loss orders and the negatives. One thing is the pros are able to see your stop loss in there and trigger the stop. I've heard of it done many times in the past. I'm sure with the high frequency fraudulent trading, it happens all the time. So how do you avoid that situation?
FSN Radio. It's all about what's next.
Lumina Gold, ticker symbol LUM on the Toronto Venture and LMGDF on the OTC, is yet another of legendary mining investor Ross Beatty's Lumina Group. It's advancing the largest primary gold deposit in Ecuador. The resource is estimated to contain 16.7 million ounces of gold and 2.2 billion pounds of copper. At just $7 US per ounce gold equivalent, it trades at an incredible 13% of its net present value. More good news is on the way with an updated PEA study expected in Q2 of 2020. It has unparalleled infrastructure. There's grid power to camp with plentiful, inexpensive hydropower available. It's close to 2 ports and is just 8 kilometers from a paved highway. Water is plentiful. It's at low elevation, and the closest community, which is very supportive of Lumina's effort, is just a 7-kilometer ride. With all this going for it, it's likely to follow the typical Ross Beatty formula, which means big returns to shareholders. Find out more and sign up for notifications at luminagold.com. That's Lumina, Lumina gold.com.
The Financial Survival Network. It's all about what's next.
You know, I think to a certain extent that's out of our control. So I'm comfortable going with below current trading ranges. Another question a lot of people ask me is, should I put a stop loss on all of those shares or just a portion? Generally speaking, if I'm going to use a stop loss, which I don't actually use that often, but if I am going to, I put it on all of the shares of a particular stock. And usually it's because the stock has run up dramatically. Like last year, Apple doubled and Blackstone Group doubled, and so did all the other alternative asset manager stocks. And once a stock, and to me, that the stock is morphing at that point from an investment into a gamble.
Speculative.
Because frankly, no normal investment doubles in a year, right? So, So now that it's a gamble,
Certainly
I'm like, okay, I didn't buy this to gamble. So let's put in a stop loss on all the shares. And if I'm up 100% now, but then it sells and I get out with 85% net profit for the year, you know, I should be very happy and grateful. And then just be ready to move on to something that's undervalued with far less risk.
Yeah. And look, that brings a good point of selling. When do you sell? Like, I learned the only way I personally, as a somewhat emotional investor, have been able to make money is to sell half when it doubles, assuming it does. So when you're in a situation where a stock does double, or like a Tesla, my friend bought it at 300. It's close to 600 now. I said, well, what do you think it's going to go up to? 6,000? You think it's going to be like Bitcoin? You always say, you know, Tesla is the Bitcoin of stocks at the moment. And I said, well, I don't know. And I said, well, that's exactly why when it goes down, you're not going to take profits. So, you know, having that discipline of having a strategy to take profits is really important here, and not enough people do it.
Yeah. Yeah. Have a plan, stick to your plan. And then if you're implementing your plan and over time you're cringing a little, like, I don't know, I'm not loving this plan, then I think we need to talk to other people who do the same thing that we do and find ways to tweak our strategy to make it better. Because again, you can't be good at stocks overnight. I've been doing this for 32 years, and the increase in my knowledge and skill, even just in the last 5 years, has been incredible. So you can't just be doing this for 1 or 2 years and think you're going to make a lot of money and avoid most of the pitfalls. There's a big learning curve there. And I think one of the things that investors lack is generally any kind of group of other investors that they can chat with. You know, this is what I did with my portfolio. This is how I used to handle it. This is how I think I might improve it in the future. And then somebody else pipes up and says, hey, I do that. And I like it. And here's the only feature of it that I'm not fond of. Does anyone have experience with this? And sometimes I think I should just like go on the road and talk to large audiences about things like dividends and stop loss orders and why are healthcare stocks so different from energy stocks or whatever, and get people talking because there's just such a massive benefit of learning from other people's experiences, and that's just not available in the entire investor industry.
Yeah. And I think that's really important. What you say of learning from others, because sometimes they're able to learn from others' mistakes without having to pay the price of them.
Mm-hmm.
So where do you put your money in? Because assuming that the market will go higher at some point, then you got to be ready.
Yeah, right now, I'm definitely expecting a correction. And let's pretend that today's the last down day and the market goes right back up. Well, it's only down a little bit from the recent high. So if I had a whole bunch of money, let's pretend someone gave me $1 million today. I would invest very little of it today. If the market was stable a week from now, I would invest a good chunk of it, several $100,000, but I'd keep more than half in money market because, as I said, we're still up close to 10% from late November. I love to buy during corrections. And so I would be pretty much holding a whole bunch of money aside for a correction. The correction will come because it always comes. And, if I have to wait 3 months or 6 months for the correction, I can be patient and I can enjoy playing with the 30% or so that I invested today. But I don't think this is an excellent time for people to be deploying a lot of capital just because the odds are so strong we're getting the pullback. And then once the pullback comes, call me, Terry, and say, okay, Crista, I think this is it. Let's talk to people about what to buy. And, I'll say, let's go shopping and we'll talk about the pros and cons of different stocks. And but I definitely am anticipating buying within the leisure travel industry. The only travel stock that recently has been on my buy list has been JetBlue, based on valuation and earnings growth and, fundamental numbers, because that's really where I always start is the numbers. But I anticipate valuations will come down on many others in the coming weeks, and maybe a few more of those will land on my buy list.
And that's a good thing. And so you got a shopping list, keep the shopping list handy, but what if it's protracted? Then what are you going to do?
Protracted, if we have a protracted, let's say, ugly market, I think the odds are much more that it'll be stuck in a trading range than it'll fall tremendously, because the big falls are usually triggered by something big and economic, things like recessions. There's no recession in sight for sure. So I'm anticipating the worst case scenario is that the market gets stuck in a trading range. And I'm very good with trading ranges because, when a stock has an identifiable trading range, you can just, buy at 42, sell at 49, buy again at 42, sell at 49. And other stocks also have their trading ranges, but they're all going up and down in slightly different patterns. And so that to me, that's just, I could do that with my eyes closed.
Yeah, well, that's, maybe that's not for the average person, though.
I know it's not for the average person. So then, they just want to have their money in, some equity funds. They want to be diversified, make sure that their money isn't all in equity funds, for example. You want money market, maybe you want real estate, maybe you want bonds, et cetera. But if you're going to be in an equity fund, you need to understand that there are boring stock years, fantastic stock years, and negative stock years. And they all average out to help your assets grow over time, just about in a double-digit area. I'm thinking maybe somewhere near 10% a year versus money market funds beating inflation. So don't get too greedy. If we get a slow period in the stock market, find something else in your life to focus on for a while and let your money stagnate a little bit, grow a little bit, grow a lot. It's going to alternate. It's okay. That's what the stock market does.
Yep. Agreed. That's the markets tend to fluctuate for sure. Hey, so you mentioned dividends. So they're at incredibly low rates, lower payout rates and low yields. And what are your, how do you pick a good dividend aristocrat, as they're called? Besides the point that it should have uninterrupted payout of dividends for X number of years, and what percent it should be yielding, et cetera.
Okay, you're in luck. I'm going to name you some stocks. So I always start my research, but there are about 1,100 stocks on the list that I review on a very, very regular basis. And I go through them to make sure there's good earnings growth and relatively low PE. And then the next thing I look at is the dividend. And then if a stock passes all my fundamental screens, I stick it on my spreadsheet. And I'm looking at my spreadsheet at this moment. And here are some really good dividend stocks where the numbers also look good. Abercrombie and Fitch, 4.5%. CNA Financial, I think because they have a special dividend each year, that's more like 7.5%. Designer Brands, 6%. Dow Inc., 6%. General Motors, 4.5%. It goes on and on. So between 4 and 7%, I've got at least a dozen attractive stocks here: ExxonMobil, Total, Royal Dutch Shell, Valero Energy. So definitely a lot of the energy stocks. And we know that energy stocks have been real low this whole decade. So it may be the best way to go shopping for dividends is to identify which sectors have been lagging all the others, because as stock prices fall, their dividend yield becomes higher in relation to the stock price.
Right.
Yeah. And then just, I don't know, read stock research that talks about the best stocks within the sector that's down right now. And you're going to find some good dividend opportunities.
Mm-hmm. Interesting. So, okay. So you're all for dividend plays, as they're called. They're generally not fast growers. They're more mature industries, and they're companies that pay out because, in theory, at least, the opportunities to invest in their ongoing business. They don't require all the cash flow that's being generated by the company. How do you find the ones that, or how do you avoid the ones that there's a potential if things get tough, they're going to cut their dividend?
I will give investors a quick rule of thumb. If a company is buying back their stock and they have an attractive dividend, almost always the dividend is extremely safe. And here's why. Let's say you own a company, you buy back stock, and you pay your investors a big dividend, and then your finances start to get sort of tight. The first thing you're going to do is stop buying back stock, right? Because nobody pays very close attention to who's buying back stock and who doesn't. And then at the end of the quarter, when you announce, I bought back 50,000 shares, you're still spending your cash on something that's completely unnecessary, which means you still have plenty of money to keep the company operating. If you completely stop buying back stock, then investors can be like, Kerry used to buy back a lot of stock and now he doesn't do that anymore. I wonder if his finances are in trouble. And then they could look at your profits and losses, your cash flow. They can look at the balance sheet things, or they go to their Wall Street research and they say, let's look at Kerry's company, based on what Morgan Stanley says or what Deutsche Bank says. So as long as your company is currently buying back stock, you don't need to worry about the dividend. And if they stop buying back stock, then pay attention to it. So this is something an investor can look at literally just once or twice a year and be confident that their dividend is safe.
Okay, well, that's a good rule of thumb. That I never heard that one before, but it makes complete sense.
But it totally makes sense, right?
Yeah.
And this is my thing. I'm like the most logical person in the world. This is how I figure stuff out.
I like it.
Okay.
All right.
Because I can tell an investor to do it and they can be like, well, yeah, I could look once a year to see if they're still buying back stock. It's not that difficult. Mm-hmm.
Yeah, it's going to be on the balance sheet. It's going to be on the cash flow statement.
Every quarterly report, or you could go to marketwatch.com and it shows the outstanding balance of number of shares every year for the last 5 years. There's so many ways you can look that up within like 2 minutes, and you can just put it on your calendar every year on, August 1st. I'm going to check to see if my companies are still buying back stock.
Yeah,
right?
I like it. Mm-hmm. All right.
Thank
All
you.
right. Well, hey, appreciate the advice there, Crista. Just tell us where we find your work, how we connect with you on the web.
Okay. I write a stock market newsletter, and the website is called cabotwealth.com. Cabot is CABOT, And, people can scroll around on the website, find my newsletter, which is called Cabot Undervalued Stocks Advisor, or they can send me an email, Crista@cabotwealth.com. Crista is spelled Crista.
All right. Excellent. And any questions for Crista, myself? What do you think about the idea of stop losses, of following these dividend stocks? Email us, kl@kerrylutz.com, Twitter feed @KerryLutz, Facebook page is Financial Survival Network. Same thing with our home site, financialsurvivalnetwork.com, and sign up for the newsletter. Crista, a pleasure as always. Thanks so much for stopping by.
Thank you, Kerry. Great to talk to you today. Bye-bye.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.